Sawadika. Welcome everyone to TDPK Talk English session is now back. We are now on TDPK Talk Startup Classroom episode 11. Topic today is term sheet, everything a founder should know when fundraising. Being presented with the term sheet, we can intimate experience of our founders. During this session, we'll be leveling up playing field between investor and founder by giving founders insight to a better understanding to the next term sheet they receive. Okay, so now please may I welcome Mr. Gagan, CEO of Vals Globals.
Yeah. Thank you, Sai.
Hello, Sawadika.
Sawadika. So, hello everyone. Thank you for taking out time to be in this session. My name is Gagan Singh, and I'm co-founder and CEO of Vals, an investor matching platform that connects startups for their primary fundraising and secondary transactions. A little bit of background about myself. So I have been actively involved in the startup space for almost a decade now. For the first few years, I was with a venture capital firm called Inspire Ventures. I was managing a small fund of approximately $40 million. So during my tenure at Inspire Ventures, I did approximately 6 to 7 deals, a few good ones and a few not so good ones, unfortunately, but I learned a lot. So after spending few years at Inspire Ventures incubated a tech logistics company called Delivery, and I was given an opportunity to run it. So as you might imagine, this was a great opportunity, so I pounced on it. So I ran Delivery for approximately 7 years in the capacity of Group CFO. Delivery today is a Series C company and has raised around approximately $120 million in both equity and debt financing. Now, since I've gotten an opportunity to be on both sides of the table, I understand the challenges founders face while going through the term sheet negotiations. And that's what this session is all about. During the next 45 minutes, we will be discussing the key elements of the term sheets, which every founder must pay special attention to. And for the remaining 15 minutes, we will do a Q&A session to address any questions you may have. So, Sai, are we good to go?
Yep, okay. I give the floor to you now.
Okay, thank you very much.
You're welcome.
Okay, so term sheet. Reaching to that stage itself is actually an exhilarating experience for any founder. Now, founders work endless hours to get their operations in order, get accustomed to countless no's while dealing with either the customers or the investors. And after finally tirelessly hustling for months and months, they get a term sheet from the potential investor. But what is this term sheet? As you can see on the screen, term sheet is a non-binding agreement that lays out the financial terms of the proposed investment in a company. That means legally, it has no value, nor founders can have any legal recourse in case the investor backs out. Now, but regardless of that, institutions who issue the term sheet take it very seriously because it is tied to their reputation, and they only do it after they are satisfied with their first round of diligence of the company. And based on our experience, more often than not, the deals in which the term sheets is issued actually materializes. So in a nutshell, even though term sheet is a non-binding agreement, it is still considered seriously and is the first stepping stone for your fundraising process. And essentially, the term sheet encompasses how your closing documents like shareholder agreement, share subscription agreement will essentially look like. Now let's start going through the key terms. So the first term, as you can see on the screen, entails valuation. Now, we all know that whenever we get a term sheet, this is any founder would pay attention to in the first instance. So let's quickly go through it. What is pre-money valuation? Now, this is actually tricky because regardless of simplicity, many people get it wrong. So pre-money valuation is the valuation of the company prior to the third-party investment. That means what is the market value of the company as of date before the investment is done into the company. That what essentially pre-money valuation means. Now, there are multiple ways this pre-money valuation is determined. Few of them being what's your top line revenue, how are your key KPI metrics, what kind of intellectual property you have developed. So some of the commonly used valuation methods I have laid down below on the screen, as you can see. The first one is the discounted cash flows. Now, discounted cash flows is actually a financial model that determines whether the investment is worthwhile based on future cash flows. What it means is that the person who is doing the valuation will see your projections and see how much profits or how much free cash flows you are generating in the future. And then they do discount it based on the present value and then arrive at the valuation of your company. Now, because most of the startups, early stage startups, are not profitable, this discounted cash flow valuation method is not very commonly used by the people who are evaluating the company. But it is extremely common when you reach the late stage, be it Series C round, Series D round, and henceforth. The second and the more common valuation for early stage startups is the trading multiple method. As the name suggests, it is a multiple of a certain key KPI metrics. It can be your top line GMV, gross merchandise value. It can be your top line GTV, gross transaction value. It can be your top line revenue, and it also can be a multiple of your gross profit. So as you might imagine, so there are multiple parameters based on the type of industry you operate in, of which this multiple is taken. And it can be, for early stage companies, can be 10x of your top line revenue. And in some cases, it can also go up to 20x. So trading multiple is in today's day and age, and especially in the region where we all are based, is one of the most common valuation methods. And the third is a precedent transaction method. It's a very basic method where the valuer analyzes what is the price paid for similar companies in the past. So they see the trend, they compare you with the other similar companies, they see that company's share price, and based on that company's share price, they decide the valuation of your company. Now, this is the pre-money valuation and how it is derived. Now, what is the post-money valuation? Post-money valuation is essentially your pre-money valuation plus the capital injected into the company. That means the amount of investment received by the company is added to the pre-money valuation to arrive at the post-money valuation. Let me show you an example to overly simplify it. Now, in this case, as you can see on the screen, the pre-money valuation of the company is $4 million. The fresh capital injected into the company is $1 million. Now, more often than not, we see investors who say, okay, your company's valuation is 4 million. I put in 1 million. I should get 25% of the company. But that is not right. That is absolutely incorrect. Because the way shareholding percentage is calculated is that you take fresh capital as a numerator, your investment amount as a numerator, and denominator is always post-money value. That means after you have invested the company. So as you can see in this case, the pre-money is 4, the fresh capital is 1 million, and the post-money valuation becomes 5 million. And the shareholding percentage is not 25%, but it's actually 20% because 1 divided by 5. The denominator here in this case has increased by the investment amount. Henceforth, the shareholding percentage has come down. Now, I've given a very important note in the bottom of this presentation, as you can see, especially this slide, where I'm saying that it is good to have a good valuation and a higher valuation, but sometimes it can go against you, especially in today's world. As you know, the macro environment is not so conducive for VC's investment. Not many deals are happening. So what is happening is every now and then we are hearing a lot of down rounds are happening. Now, what is down round? Down round is that the company's valuation has dropped from the previous round. So what happens is if you raise money during good times at a higher valuation than what your company deserves, then in that case, you sometimes put undue pressure on yourself as a founder to keep generating higher returns to make investors happy and to meet their expectations, which more often than not is not feasible. And that's why you fall into this valuation trap. So I have a specific slide later in this presentation which discusses that. So I will take a pause on this, but please keep this in mind, the valuation benchmark and the correct valuation, because it can have a very important impact, or a very major impact on the founder's equity shareholding. Now, the second term is the security type. So what is a security type? So since the investor decided, or investor is thinking to invest in your company, you have to give something in return to the investor, right? That means the company has to issue something to investor in exchange of the amount in exchange of their investments. So that in exchange of the investments, what companies do is that they issue security to the investor. Now there are different kinds of securities which companies can issue to the investors, but I have laid down only top four, which are very common in this part of the world. So I'll quickly go through them. The first one is the ordinary shares. So ordinary shares are issued at the time of incorporation. So they are also called common stocks, and they give the shareholders the right to vote in a company, right to receive dividends, etc. So founders' shares, that means that at the time of incorporation, founder is the sole shareholder more often than not. So they more often than not hold ordinary shares into the company. Now, the second is the preferred shares. And for investors, it is extremely common for them to opt for preferred shares because they invest at a higher valuation of the company. And in exchange of that, they want shares with special rights. So as the name suggests, preferred shareholders, or the one who receives the preferred shares, have superior rights over ordinary shares. That means they have stronger rights on the company. Second is they have preferred dividend payouts. So for example, if the company becomes profitable, then preferred shares receive dividends before ordinary shareholders receive dividends. And this keeps on changing. So as the company raises Series A preferred shares, Series B, Series C, so the later stage investor will have stronger rights over previous stage investors. What I mean is that Series B shareholder will have stronger preferred shares than Series A shareholder. And then Series C shareholder will have stronger shares than both Series A and Series B shareholders, and so on. Now, the third common type of securities are warrants. So warrants are essentially not shares, but option to purchase shares in the company at a predetermined price and during a specific time frame. So for example, investor invests today in exchange of warrants. So they will say, okay, let's fix the price for these shares, say hypothetically $100 per share. And they say that, okay, I can invest in your company at $100 per share for the next 10 years, anytime, whenever I feel good. So investors do this because they don't want to get hassle of extensive paperwork, and they feel that they will only take the shares once the company's value grow. So that's why they opt for these kind of solutions as well. Although warrants in its own shape and form are not very common, if they are essentially added to other form of financing, for example, venture debt. What I mean by that is if you take debt from a company, then the lender also adds warrants as for specific upside. And what they want is that I want more rights in the company. I want an option to purchase the shares. But for primary equity financing, the more common one are first ordinary shares and second preferred shares. Warrants, not so much. And the last but not the least is convertible debt. So convertible debt is essentially a debt which gets converted into equity at a later date. The reason why convertible debt is so popular is because it's a faster form of financing, as you don't have to go into the valuation, because we want to defer the valuation at the later date. Because as you might imagine, just discussing haggling on the valuation or negotiating on the valuation can sometimes be a really cumbersome process, can be a really difficult process. So in order to avoid this, investors say, okay, I'm investing money as a debt in the company, but I will convert this into shares at a later date. But what I want is I want discount because I'm investing now, and the new investor will come, say 6 months from now or 1 year from now, and the company value will go up in this time. So I want some upside on that. I want some advantage of that. So for example, if I invest in a company for a convertible debt and I get 20% discount, and the next round of companies is happening at say $100 per share. In that case, the company will issue me shares at 20% discount. That means $80 per share. Why I got this discount? Because I invested earlier, and I before the investment happened, and during that period, from the date of my investment and from the date the actual equity financing happened, the company valuation actually went up. So yep, so ordinary shares, preferred shares, warrants, and convertible debt. These are the four common types of financing in Southeast Asia. Now, here is where it starts getting really interesting, guys. So for liquidation preference, although as the name suggests, many people think that it's like the order of investment, but it is much beyond that. And it is a very, very important clause because it can actually significantly impact the founder's share in the company. So please pay attention on this. So if I'm a founder, the normal way founders calculate is that, okay, I own 20% of the company and the company's value is $100 million today. So I have my shares are worth $20 million and I will get $20 million. That may be true, but that might not be true depending upon what liquidation preference rights have you given to your shareholders. The first one you can see here on the screen, there are actually four. So we'll go one by one through each of these preference structures. So the first one is preference stack. What it means by that is it is similar to preference share structures, like Series B shareholders will get payment first over Series A shareholders. Now, if a Series C shareholder, C will get paid before B and A. So the later the investor comes and invests in the company, they will be paid first. And then once they are paid, only then other people would be paid in the company. Now, this has a significant impact. This order of payout has a significant impact if the company doesn't have that much money. So sometimes it happens is the investor, Series C investor takes their money, Series B, Series C, Series A, and so on. And by the time the founder's chance comes, there's very little money left in the company. So yes, preference stack, although very common, doesn't give the founders that much upside if the exit value is not so high. The second is a multiple. So multiple is essentially an extension of preference stack, but it is on top of that, a certain multiple of investments is committed to the investors. What I mean by this is, so I am, say, for example, Series A investor, and I invest $2 million in the company. Now I have, say, for example, 2x multiple on investment. Now, in that case, what I mean by that is, so when the company goes into liquidation, regardless of the value, the company will first need to give me 2 times of my investment, that is 4 million. And once they pay me, only then the remaining money they can distribute amongst the other shareholders. Now imagine if there are like 4 shareholders who have these rights. So the first shareholder will be paid double, the second shareholder will be paid double, the third, and so on. So by the time you reach the money because your founders are on the bottom of the cap table more often than not. So by the time their chance comes, there's very little money left. Now let's focus on third and fourth. I'm calling them 3A, 3B because they're somehow interrelated, but these are the most common ones. So the 3A part is non-participative liquidation preference structure. What it means is, if you can see on the screen, the first point is the investor here have 2 options. The first option is receive an amount equal to your investment, or convert your shares into ordinary shares and take the money equivalent to your shareholding. For example, I invest, say, $1 million in a company for 10% of the company. Now, the company's exit value, like the company is sold at, say, $8 million. Now, I have 2 options. either to take $1 million, my capital back, or 10% of the exit value. Exit value is $8 million, so 10% of $800,000. So no points for guessing. Investor will always take option one. That means they will take $1 million because 1 million is more than 800,000. Now, on the if you change the exit scenario, that means let's say you'll make the company's valuation $20 million. In that case, they have one option, $1 million, which they can take back, or 10% of 20 million, which is 2 million. So in the second case, the investor will take the second option. That means take $2 million. So non-participative, for me, if you ask my personal opinion, is the most balanced clause in the liquidation preference structures. But then comes the participative, and we have seen this clause a lot. Like we have seen this clause a lot of in a lot of term sheets. So what is participative liquidation preference? And it's actually very, very, I'll say, pro-investor and not in the favor of founders at all. What it means is that similar to non-participating, you have two options. That means first, your investment, and second, your shareholding percentage in the company. But it is not or, it is and. That means we will first get paid our $1 million, and then we will also get 10% of the balance amount in the company. Imagine that. So for example, if the company is, say, sold for $8 million, so first the investor will get $1 million, then $7 million left, then they will get 10% of $7 million. That means $700,000 more, so $1.7 million. So imagine if, again, going to structure by structures, because once you give these rights to your early shareholders, all the shareholders, and I can confidently say, it is very hard to change the rules for the later stage shareholders, because once the terms are agreed with the first shareholder, for all your future rounds, these terms will keep on copy pasting and keep adding to your shareholder agreement. So imagine if you pay so much money, like first their investment, then their shareholding, there will be absolutely very little to no money left, regardless of your shareholding in the company, because of the participative liquidation preference. So what I highly recommend is, and I'll be talking later in my presentation as well, please try your best to not allow participative liquidation preference in the term sheet, because it will put you in a very difficult situation once the company goes into exit. And I can prove this with the example which I've given here. As you can see, there are different scenarios. So multiple 2x, how will the liquidation payout look like if the multiple is 2x? How will the liquidation payout look like if it is non-participative, and how will the liquidation payout look like if it is participative? So you see the founders, how much money founders are getting. Assuming $100 million exit value, in the first case, ideal case, founders should get 35 million. In the second case, founders are getting 26.25 million. And in the participative case, 31.5 million. So how significantly founders' share is increasing and decreasing depending upon the kinds of rights they have given, or kind of liquidation preference rights they have given to investors. But out of all these rights, participative right is the most unfavorable, because generally it's not 1x. This I took 1x example. It's actually much higher. So the impact is much, much higher on the bottom line for founders. Now let's talk about anti-dilution. So let's circle back to what I mentioned about higher valuations in slide number 4. The impact of down round has a considerable effect on founder shareholding. An anti-dilution clause is actually one such clause that protects the investors from such down rounds. What I mean by this is that, for example, if investors invested in a company at a $50 million valuation, and 2 years later, the company is not doing so well, and companies devalued or reduced value to $20 million. In that case, this anti-dilution right actually protects the investor. That means they get more shares issued in the company because they invested at a higher valuation, and which is not justifiable anymore. So the downside risk of the company going down in the future only lies with the founders because of this clause, and it has a very limited impact on the investor. So there are two types of anti-dilution provisions which we usually see in the term sheets. The first one is the full ratchet. What it means is that, for example, an investor invested, say, $100 for one share in a company. And 1 year later, the share price of the company reduced to $50. Now, in that case, the company needs to issue one more share free of charge, because had the price been 50, I invested $100, I should have gotten two shares. So company will issue one share additional free of charge to the investor because the company's share price has gone down. Now, because of this, as you see, if you issue free shares, the total number of shares in the company increase, and what happens is the founder's shareholding in the company goes down. The second, and the relatively fairer way to calculate anti-dilution, is the weighted average method. Now, there's a specific formula which actually governs this. And I won't go through what this formula states, but in a nutshell, it actually takes the ratio of the number of shares that were actually issued versus the number of shares that should have been issued at a lower price. So the impact of weighted average dilution is much smaller than full ratchet. Let me show you an example of this in the next slide. So in this case, the pre-money valuation of the company was $100 million. The investor invested $10 million. The price per share was $100,000. So after investment, this is how the cap table looked like. Investor was holding 9.1% of the companies, and the remaining 90.9% of the companies were still with founders. Now, what happened was company didn't do well, or the macro environment changed, and the new valuation of the company became $50 million. And there came another investor who said, okay, I will invest $10 million in the company. But in that case, what happened is, because the valuation is now $50 million, the share price has dropped from $100,000 to $45,455. Now, if you follow the formula of full ratchet clause, the company had to issue 120 shares additional free of cost to the investor, the old investor. But if you use the weighted average ratchet clause, they just had to issue 11 shares to the investor. So as you can see, in the full ratchet clause, the shareholding of the founders have dropped to 32.79%, whereas in the weighted average clause, it's still 36%. So the impact of the lower round is much lower for weighted average ratchet versus full ratchet. So you should, again, be very careful when you look at the anti-dilution clause. Like, you can't do away with it, because it is investors are investing money in your company and they need to be protected for valuation. But by just agreeing at a different methodology, you can significantly impact your shareholding in the company. And no points for guessing, weighted average ratchet clause is clearly much better than full ratchet clause when it comes to protecting financial interests of the founders. Now, the next is preemption rights, also commonly known as right of first refusal. What it means is that if I am an investor in the company and I own 10% of the company, now, if a future investor comes in the company in the future and they want to put in money, my shareholding will get reduced, right? Because the new investor came, so old investors' shareholding get reduced. But if the shareholders have these preemption rights, they have a right to top up. What I mean is, right to invest more money in the company to protect their shareholding to the original percentage, which in my example case is 10%. So as you can see on the screen, the numbers, I've given the exactly same example. So number of shares held by investors were 100. Total number of shares in the company was 1,000. Investors' shareholding was 10%. If the company is issuing 500 more shares to new investors, then I, as an investor, has a right to buy 50 more shares to protect my interest in the company, so that my shareholding still stays at 10%. Now, from the outside, it might look like a very fair clause, and it is actually. Shareholders should have full rights to protect their shareholding in the company. But sometimes there are different versions of these rights, which investors ask, which can go against the company and can significantly prohibit company or restrict company for raising the future financial rounds. So that's where this clause gets complicated. So it is very important that once you're agreeing to these preemption rights, you clearly go through the language that it is intended for a certain purpose. But if there are any additional rights, like right to take the new round in full, or any other round robin clause, where if one investor declines to take their shares, other existing investors can take the remaining shares, that's where it gets complicated, and it significantly restricts the founder's ability to raise future financing for the company. So yes, from the outside, it is not that critical, but again, if it is maneuvered in some shape or form, then it can actually impact the company significantly. Now, clause number 6, tag along and drag along. So if I sum it up, tag along rights protect minority shareholders' interest, while drag along rights empowers majority shareholders. Now, what is tag along right? Tag along right gives minority shareholders right, but no obligation to sell their shares to the investor in the company. What I mean by that is, if there is an existing shareholder in the company who is selling his shares third party, then the minority shareholder have the right to say, hey, you are selling your shares, I also want to sell the shares, but it should be at the same terms. But this is optional. Like, it's a minority shareholder call whether they want to sell it or not. But if they want to, they have the right to demand the same price from the buyer, that okay, now you're buying one of shareholders' share, you also need to buy my shares. So this is tag along right. This protects minority shareholders. So there is a certain threshold for tag along. What I mean by threshold is that if the founder is selling 5% of the total shares of the company, more than that, then only tag along rights can be triggered. But if it is less than 5%, then tag along rights cannot be triggered. So because, in the shareholder agreement, you don't want to make every process of selling extremely cumbersome, because investors in some cases just want one person's share. They don't want every person's shares. So deals do not materialize. So that's why tag along rights have a certain embedded threshold in them, which in common parlance, or what we see usually, is around 5%. So to put it simply, if somebody is selling more than 5% equity of the company, then the minority shareholder can say, sell my shares also at the same price. And if they are not able to sell your shares, they will be restricted to sell their shares as well. So this is what tag along right says, protects minority shareholders' interest. Now, what is drag along? Drag along is different. Drag along is like, for example, I, as a founder, hold 55% of the company. So I am a majority shareholder. And I got a buyout offer from say, a big corporate who wants to buy a company for $100 million or whatever number. And I'm comfortable selling it. Then in that case, I have a right to ask all my shareholders, I can force all my remaining shareholders to sell their shares at the same terms which I am selling my shares to the potential investors. So that means I can drag all the existing shareholders and ask them to accept the money at the same terms which I am accepting. The reason why drag along rights exist is because you don't want minority shareholders to stop a big transaction in the company. You want to give some added power to the majority shareholders to make decisions on behalf of the company. And it actually works in the favor of minority shareholders too, because it is extremely unlikely that the majority shareholder, will sell the company at its less than market value, because they are also getting paid as well. So that's why this drag along right exists. But drag along, unlike tag along, is mandatory. That means I have a right to do that. I can do that. You cannot say no. But tag along is, as a seller, I can decide whether I want it or not. So tag along is an optional clause, whereas drag along is a mandatory clause. Then comes the redemption rights. Now, what are these redemption rights? Redemption rights is essentially right to sell the shares back to the company. That means if I am an investor, I bought shares of the company. I have right to sell my shares back to the company whenever I want. So these are actually redemption rights. Now there are multiple shapes and forms in which these rights exist. Like sometimes the clause says that that the shareholder has a right to sell the shares after 5 years of investment. Sometimes it's 10 years. Sometimes if the company becomes profitable but they are not big enough to go IPO, then I have a right to sell my shares back to the company, and the company will be forced to buy. But still, I mean, this clause is actually quite tricky, because if you give this clause and you say 5 years, and 5 years down the line, company is not profitable, and investor and shareholder is or an investor is forcing you to buy the shares, forcing the company to buy the shares, then you might not have capital to buy those shares, or it might not be advantageous for the company to buy back the shares. So that's where it gets really tricky. So redemption rights, if possible, should be avoided by the founder. Now, there's some one more clause which we have seen, which says that redemption rights at $1. Now, the reason why investors keep this is that, for example, founder is for some reason unethical, and the investors don't want their name to be associated with the company, or there is a um, legal implication on the company because they were operating in a gray area. So investors don't want anything to do with the company. So then they say that we want redemption rights at $1. What that means is I should be able to sell my shares at $1 and get rid away from the company, so that tomorrow, if there is any legal litigation happening, I should stay away from it. Now that is understandable, $1. But if you commit a certain returns to the shareholders after a certain period of time, then think twice or maybe thrice before agreeing to it, because it might get you into extreme trouble. Point number is board matters. So when the new investment comes in, especially during Series A round, more often than not, the lead investor, that the investor who's putting the biggest check in the company, expects a board seat. So normally the board comprises of 3 to 5 members, and the board of directors, as you know, take decisions on very important matters on the company. They are called reserved matters, which are specifically laid out on which topics or instances board will make the decision, and not the management of the company. So yeah, so that's why they want to have a deeper or better control on the operations of the company and more visibility. That's why investors ask for board seat. So what we recommend to companies is that it is good to have new board members, and sometimes it is massively advantageous too, because you get to capitalize on the expertise of your investors. But until Series A, at least until Series B, the management or the founders should try to have majority of the board seat. For example, if there are 5 board seats, you should try that internally your team or your company should have 3 board seats, so that you can decide the matters to work in your favor versus the investors or third parties' favor. Now let's go through some of the common reserve matters. So first is any change in shareholders agreement, shareholders rights, or any principal activities of the business requires board approval. Then winding up the company, if the management decides to wind up the company, they require board approval. Securing third party debt beyond a certain limit requires board approval. Appointment of key people like CFO, COO, and any other C-level management sometimes requires board approval. Appointment of auditors, amending business plans, and any transaction involving directors and shareholders. Now, these are the basic general reserve matters which are fair to have in your shareholder agreement, but founders should refrain for giving too many reserve matters, because you have to run business at the end of the day. And if you're focused, you're going through the governance and bureaucratic processes on seeking board approval for small matters, it might make you distracted and deviate you from your core operations. So be very mindful and always try keeping it very high level rather than putting very small ceilings so that you have to go back to your board time and again. Point number 9 is founder restrictions. So when the investors invest in a company, they are investing in the more often than not, they invest in founders and not the company, because companies keeps on pivoting. Even we have seen Series A, Series B companies sometimes pivoting, coming up, taking a different path. So investors, that's why more than investing in the company and the idea, they invest in founders, and they want founders to commit to the company and run the companies, because investors have money, but they don't have time to come and run your company for you. So that's why first clause, which is a very common clause, is called a key man clause. That means from the date of investor's investment, investor wants you to stay with the company for a minimum period of 3 to 4 years. And if the founder leaves the company during that period, then they lose a large majority of their shares, depending upon the kind of penalty founders are put on the key man clause. But when you see this clause, you shouldn't be scared, because you are essentially expected to commit to the company 100%. And there should be no reason why founders should be afraid to sign this clause. The second is a non-compete and non-solicitation, as the name suggests. Well, if the investors have invested in the company, they've invested in you, the last thing you want to do is leave that company and start a competing business, or leave that company, start a new business, and solicit all your old team members. So that's why these are the basic protective provisions for the investors. And even in all the employment contracts, we see this non-compete and non-solicitation. So it's a very basic right, and every founder should accept it. The third is indemnification, and this is slightly tricky. Now, founders are sometimes asked to provide indemnification in case of breach of warranties. So that means if founders tell investors something before the time of investment and that turned out not to be true, then the investors can penalize founders and ask them to indemnify them, protect them from losses, and pay them money because they don't want to incur loss, because they trusted your warranties, trusted your statements. So now indemnification to a certain degree is okay, but there should always be a cap. Like, you should always cap the maximum value you want to indemnify the investor. Because sometimes when you're running a startup, you also don't know what's going to happen. You want something which is not 100% sure, but you still want to go for the investment. But then you should always have a cap to protect you, like the maximum losses which you are willing to take for such indemnification. And point number 10, there are some other reserve matters. No shop clause. This is very common as well. So when the lead investor starts doing diligence in your company, they issue you a term sheet and they tell you that please do not speak to any other investor unless we complete our diligence. That period can range from 30 days to 60 days, because investors don't want you to shop around and try reaching out to 5 investors after the term sheet is issued to increase their valuation. So that's why they want to protect themselves, and they want to focus on diligence, and they want to close the deal. Last thing they want is you trying to get similar term sheets at a higher valuation from other investors and use that as a negotiating point against the VCs. So no shop clause is very common. ESOP pool reserve. This again is very tricky. So we all know that in order to build a great business, we need to attract right employees. So investors expect the company to set aside an option pool, which usually around 10 to 15%. So that means they want you to have that pool set aside, like if for the future employees, and they want you to have it prior to their investment more often than not, because they don't want to dilute themselves because of the creation of this pool. They want founders to dilute themselves in order to set aside the ESOP pool reserve. That is very, very common. So the sooner you prepare for it, the better it is. Third is reps and warranties. So as we all know, warranties are what you represent, and warrants what you tell investors, the statements which you give. Warranties can be in different shapes and form. It can be legal warranties that are not in breach of any legality. You're not breaching any local laws, regulations. It can be tax warranties. That means you have paid all the taxes. It can be IP ownership. That means your intellectual property belongs to you and you haven't stolen it, and so on. So reps and warranties, founders are expected to give to the investors. And in certain cases, you get the similar warranties from investors as well. that they're investing their own money, and there are not any encumbrances, and they're not breaching any terms by investing in you. So reps and warranties actually work both ways. And last but not the least is legal cost and closing date. So, as a common practice, legal costs incurred on investment are shared between the company and investors. And there's always a closing date. That means the deadline by which the investment needs to be closed and the money should be in the bank. That means after term sheet diligence will happen. Once the investor is satisfied with the diligence, they will start working on the paperwork like shareholder agreement, subscription agreement. Once that is done, then the money will come into the account. So, in order to create an urgency, this closing date is put so that both parties know that when is the maximum time the money would be in the bank account. Now, let's what's the conclusion with this? So when you are about to raise money, everybody should prepare themselves for negotiation. But we should always pay attention to these 5 clauses, because if we agree to that, we should be prepared to dilute ourselves as founders significantly. So one of them being participative liquidation preference. We have already discussed this in length. Second is full ratchet anti-dilution. So for full ratchet, again, instead of full ration, we should always opt for weighted average. For participative liquidation preference, we should always opt for non-participative. Extreme preemption rights. That means preemption rights should be fair and square, but not too complicated. Redemption rights with higher multiple. We should not commit to pay investors 5x money in 5 years or 3x money in 5 years. We should not commit to these ridiculous clauses if there are, or because we should not overpromise them, even though we believe in the company, but we don't know what will happen. And last is too many reserve matters, because as I said, you want to run the company, you want to focus on it. You don't want to go back to board every now and then because everybody's busy. It takes a lot of effort and a lot of admin work to get every board together every time. So try keeping it high level. And lastly, how WOWs can help. So we have multiple tools and we offer multiple services to startups, regardless of the stage they are in. So our first product, which can be really helpful for all the startups, is WOWs Invest, where we connect you with the investors for primary transactions as well as secondary transactions. That means you can raise the fresh financing also while send your existing shares also. So if you want to get listed, you can get a demo from one of my colleagues. Second is a WOWs library. So if you want how a good standard template shareholder agreement term sheet looks like, you can go to our library and download it. It's completely free of charge and it is vetted by Baker and McKenzie. The third is WOWs ESOP. So as if you remember, investors expect you to set aside ESOP pool. So the sooner you do it, the better it is. So we do assist in setting up ESOPs, and we also have a software which help you manage, track the vesting schedules of your employees. So if you're interested in that, we can help as well. And last is WOWs Advisory. So if you want us to review your term sheet, if you want us to prepare your data room, prepare your pitch decks, or if you need any other advice with regards to fundraising, we are happy to help. So thank you very much. Thank you for your patience. Sai, I think we are ready for Q&A. Sai, you're on mute.
Yeah. Okay. Thank you. So far we don't have any questions from both YouTube and Facebook. But we have one comment here, Mr. Rand. He says, "Very informative and clear explanation. Thank you very much."
Yeah,
and great pressure, Mr. Gargan as well. Yep. So I think we do. If you have any question, please let us know. You can type it on the chat. On the comment sections. So, okay, we've got a question. Is it common to include some IP protection clause in the term sheet?
Is it common to include the IP, intellectual property protection clause, in the term sheet? I probably need to, IP protection. So there's a proprietary agreement, standard proprietary agreement, which generally forms part of the term sheet, which are standard clauses. So IP protection is one of, IP ownership is one part of that. But we have not seen a specific clause which asks people to patent or trademark their IPs. Although even if it's not as a good practice, all founders should do it. So if you, because you never know when somebody else trademarks your IP. So the sooner you patent it in multiple jurisdictions, the better it is for yourself. But in the term sheet, IP ownership is more considered. That means the investor want to make sure you own what you are showing them rather than patenting or trademarking as well.
Okay, thank you for the answer. I don't think we okay. Is that answer your question, Mr. Ryan? If not, you can take more. Okay, I think that's answer, and I think we are pretty much don't have any more questions. So I will say thank you very much, Mr. Gargan, and thank you very much for all the audience for us today. If you have, we're gonna have this kind of session on live on our Facebook, TDPK. Oh, and if you are interested, you can reach to tarin@wowsglobal.com as well if you have any questions. And thank you very much for today. Thank you ค่ะ สวัสดีค่ะ
Thank you, sir. Appreciate it. Bye bye.